What is up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast, Options Flows versus Macro. My guests for today's discussion are Cem Karsan and Andy Constan. Both guests are among the top traders I know who have recently made outstanding market predictions. Their outlooks, which occasionally contradict each other on the future of the markets, promise a captivating and insightful dialogue. So let's get started. Today's podcast is sponsored by FTSE Russell and TradeStation. FTSE Russell is home of the Russell 2000 Index. Did you know with an 81% share and 1.6 trillion in institutional assets benchmark, the Russell 2000 is the top choice by far among institutional investors. Like all Russell US indexes, it's rules-based, transparent, and reliable. Regularly updated with the latest IPOs and annually rebalanced. To learn more about FTSE Russell and their products, go to FTSERussell.com. Now, serious futures traders, level up your skills with TradeStation's powerful platform. Enjoy flexibility, superior trading power, and save big with 50% off brokerage fees for the life of a new futures account at TradeStation.com/Anthony. That's TradeStation.com/Anthony. Now, let me introduce our guests. Cem Karsan, founder and CIO of Kai Volatility Advisors, built his firm on 2 decades of industry-leading derivatives experience. His prior firm, Precision Capital, represented 13% of the S&P 500 options daily volume during the financial crisis. After divesting his stake in 2010, he established Kai Volatility. Karsan holds a triple major bachelor's from Rice University and an MBA from Northwestern's Kellogg School. Andy Constan has 35 years in global markets. Andy's expertise in macro investing was honed at Bridgewater and Brevan Howard. Previous roles include head of global equity derivatives at Solomon. He's founded 2 hedge funds specializing in multi-asset volatility and capital structure arbitrage. His career merges systematic quantitative research with discretionary investing insights. Andy is also the founder of macroeconomic research firm, Damped Springs. Gentlemen, it is great to have the 2 of you here today.
Great to be here. Thanks for having us. Yeah, this is going to be a lot of fun.
Thank you both so much for joining us. Now, the 3 of us, we've been in this business for a long time, and I've spoken with and interviewed really thousands of traders throughout my career. And I must say, you 2 are among the brightest minds in the markets that I've had the pleasure of interacting with. I've learned a lot from both of you, and I'm looking forward to learning more from you today. One thing I will admit, though, is that even though I've spent my life in futures and options markets, both of you surpassed my understanding on some issues, and there's no doubt about that. So I aim for today to be a high-level conversation, yet I want it to be helpful for traders who aren't at such a high level. So I really want to keep this insightful for the whole gamut, for all levels of traders. I flipped a coin to see who would start today, and Andy, you won that toss, so I'm actually going to start with you today. And the question I want to start off with today is I would love to hear both of your thoughts on the current market environment, where you think we are maybe in this cycle, and how you are both currently positioned.
Sure. Let me start off by placing some context in this conversation. I started my career and had the most formative moment in my career in 1987. I started in 86 and was soon asked to join the Brady Commission as Salomon Brothers representative to examine what happened during the stock market crash. And this topic is perfect for that because while the macro was an important factor for why the stock market started to fall, by far the most important aspect of that historic stock market crash was flows, and in particular, option replication flows called portfolio insurance. And I had the pleasure of looking at all of the flows, every single buyer and seller of futures contracts, options contracts, baskets of stocks during that time frame, and understanding what exactly those flows did and why they created such a big move in markets. And then went back to Salomon Brothers and started in 1988 trading equity derivatives and have traded them essentially ever since. leaving, as you said, at 2003 as the global head of equity derivatives, a huge business for Solomon. And during those, when I started, index options were only 7 years old. Um, Nobody had really traded them. And so the development of the global volatility market really was occurred during my period of time in which I was at Solomon Brothers, and my team was going into pretty much every aspect of the impact of derivatives on the global stock markets and the markets themselves, creating structured products that created unusual exposures that needed to go through the market, and understanding the way the volatility market occasionally wagged the dog of the global markets. And so, just to put that in context, I believe that flows are an essential pillar to understand how markets trade. My macro pillars include 4 pillars, and that is one of the key ones. And the question is, how do you add all those different pillars up so that you can scrape together some alpha and maybe generate a 55% chance of winning? And that's how I approach macro and how I approach flows, with that context of understanding the options dynamics. So I'm very excited to talk to Jem about this and hear his point of view on both options related flows. And I know the structural flows he wants to discuss as well. So this should be a good conversation. In terms of my positioning, I've had 2 big calls that were macro flow related. One was getting short all assets in mid July and the second was covering all those assets and getting long assets to on October 31st at the bottom. And so here I am, though, after this huge rally from the October bottom. And I've sold assets, and in recent days, I've gotten very aggressively short both bonds and stocks.
Andy, thank you so much for that. And I want to go to you now, Jem. We heard from Andy, and I think it was great that he talked about his 4 pillars. I'd actually like for you to touch a little bit on that as well. I think that really will help for today's conversation, really understanding the backdrop. I know it's not just options flows versus macro, because getting a chance to know you and speak with you and listen to you talk, for you, it's not just about one single thing. I know that you maybe we'll say have pillars or something similar to that nature. So also same conversation, what your same question, current thoughts on the market environment, where you think we are in this cycle, and how you are currently positioned.
Yeah, first and foremost, uh, you know, immense respect, mutual. I think there's a mutual respect here for Andy. You know, there are few people in this world that get that breadth of experience, um, uh, and have the level of insights that he has. So I want to put that out there. I respect, him, and I learn from him, much like we all learn from each other. I don't take that experience lightly. Um, I My experience is, I started in 1998, um, uh, and in the pits, right, a different world. One that I know about. Um, that world was a very guttural kind. You could see everything happening mechanically in real time. We stood and lived, like, eat, slept, breathed that for a decade plus, for honestly 12 years, and multiple crises, the tech bubble crash, eventually the great financial crisis, the apocalypse, right? You go forward to the COVID crash now. All of those I've experienced with an incredible, either on the floor or very well connected in a world where we see every little piece of what happened, much like Andy said about it in 1987, kind of depth of understanding of what was where. And that teaches you a lot. Um, what it's taught me more than anything is, above all, this is not a qualitative exercise when you're looking at prediction. It is a quantitative exercise. It is a function of, in any time period less than years, multiple years, and I would argue 5 years. My view, based on my experience, is that this is a voting machine that is supply and demand exercise. And the more you can understand supply and demand directly, the better you have at drawing a predictive probability. And that's what we're doing of outcomes. And that's what we do here. Now, so much of the stuff that I can predict is flows, right? There's structured things that I can actually measure and use to my advantage because those are things I know. Does that mean I have all of the supply and demand? Absolutely not. Does that mean even the ones I know and that I can measure that I know exactly? Often not. But what it does is it allows me to piece together a puzzle and get somewhere near 50% of the flows. And when you know 50% of an equation, that means you know a lot about the 50% of the equation that you don't know. And I'm constantly using what I do know to understand more, to train models on what we don't know as well. That's my process. I don't have set pillars. I have, 28 inputs in my model of flows. Now those flows, some are macro, and some of those macro are much more qualitative, but are then turned into ultimately a quantitative flow over time. Those are slower moving. And then we have much more fast moving kind of things like flows off the options market, flows out of the treasury, out of treasury issuance, et cetera. And so all of these things are part of the model, and they're constantly moving, and they all have different reaction functions that govern each flow. But that's how we approach things. And that, again, that is informed by my experience dealing with supply and demand as a market maker, as one of the biggest market makers in the equity index world for a very long time. I think Andy would agree. He has a general process that is not too dissimilar. The devil is in the details. And the details matter. And I think that's a lot of what we'll end up talking about today. I think we really do see the world in a similar way broadly. And I think it's a rare way that, ironically, you would think that more people would think this way. But, I would say more than 90% of practitioners do think about fundamentals and equity valuations and all these other things as drivers to their short-term decision-making. That is not my process or what I believe drives markets.
Thank you for sharing it with us. And what I love about the two of you is that you guys are traders. You might change your mind in a day, yeah, and you're going to take the information that's in front of you and you're going to use it to your best ability to make the best decision for your trade going forward. And I want to go back to you, Andy, and I want to talk about you saying you have this sell all portfolio right now. I want to really just dig in a little bit and understand why that is. I know you've mentioned QRA and we're going to definitely get into that today for sure. But talk about why you are with the sell-all portfolio currently. And also, I want you to touch a little bit on, because of what you mentioned with the options flows, why in this particular instance you believe that this is what's happening in the macro, or what you're seeing in the QRA or whatever it is that you're seeing, will supersede some of the things that Jem has talked about, end of the month, beginning of month flows, where we're seeing, how the macro flows, I've heard Jem say, is kind of pushing back, but the actual flows coming in are superseding that. I'm just curious where you sit with all of that.
Yeah, sure. So I think I'd break it down. So I think the highest level point is that my horizon is mid-February. So, I don't like the fact that my portfolio is down 200 basis points, I think, since I put the short on. I did happen to add to it on Friday, but even that's in my face a little bit. And I think the biggest thing that's surprising me about the markets is the strength in the global bond market. And that speaks to also what I think is the macro driver of why I want to be short assets. And that is that financial conditions are simply too easy for the Fed to successfully slow the economy and cause inflation to reach target. Now, it's going in the right direction, which I think is clear to everybody and has been clear to everybody for, 6 to 8 months. But this is when it really matters. This is when you're getting close to the runway and you land too fast, you have to take off again or crash at the end, or you make this fantastic soft landing. And if we have that soft landing, I'm going to be wrong on my call because a soft landing is going to be a decent outcome for um, um, asset prices. So, anyway, we can come back to the more macro when you want. But the other point that I'd like to make is that, pardon me, I have a terrible head cold. I'm going to be, we're going to have a OPEX, which is, has been a factor over the years. We're going to have a year end, and in particular, the heavy gamma from the JP Morgan collar may or may not have an impact. And then we're going to have another OPEX in January and another one actually in February before my positions expire. So when I think about the OPEX flows, I have to look past the very short-term flows and whether they are important versus my overall decision to position. But they may or may not cause me pain in the near term. And so I'm willing to accept that. It's also not something that I think I have an edge versus people like Jeff. So for me to trade that relationship, I'd rather just give that alpha to Gem and stick with what my positions look like. Now, where I think we disagree is the year-end pressures, and that's worth exploring. I guess the first year-end pressure is the classic pressure of performance chasing, that I break down when I think of seasonal flows as performance chasing and tax planning. And the circumstance, and I've written a dead Santa on that topic that's available on my Damp Spring site and on my Twitter feed. That idea is typical of almost every year when the S&P is up 10% or more, that investors with taxable gains defer the selling of the winners because they don't want to recognize a taxable gain in this tax year. And at the same time, those who are underperforming tend to chase the winners. And in this year, the distribution of taxable losses from bond holdings, Russell stocks, half of the 493 are down, and the dominant performance chasing has been the Mag 7 stocks. And that's just very different than past Santa seasonal rally type environments. And so I think we're not going to see those types of flows as investors are willing to sell their winners because they have so many taxable losses to take. And performance chasing, unless you owned the Mag 7, your performance is hopelessly behind. And so that's how I think of year end. And I also have my heart is a little bit colored, but I also have this idea that the JP Morgan collar is going to be a meaningful event as we approach year end and drive the market to 45.15, which is the strike.
So, Jeb, you heard Andy. He said Santa rallies are basically driven by performance chasing of winners and tax deferral, and he's not less selling basically in these of winners, and he's not seeing anything. This is not what a Santa rally looks like. What do you think?
Yeah, I mean, I strongly disagree. And before I get into that, though, I did kind of skip over what my positioning is. Let me lay that out real quick, and then we can talk out the why and how I disagree on this. I've been on the opposite side, and these kind of most recent call, we both called the October 31st, November 1st bottom and the decline before that. He did it very artfully and skillfully. Time on. I called strike and price, several months in advance, engaged probability as we went and rebalanced. But I think both speak to kind of our slightly different processes. Um, Obviously, how am I able to kind of go months out and kind of map out probabilities that are high probability versus low probability. Doesn't mean it's going to happen every time, but the fact that we're even able to hit strike and price month out, we've done that a bunch of times. Um, Obviously, people ask, how is that possible? How can you do that? The reality is there are calendar realities to positioning. They're not just these are not just technicals. These are not just seasonality. Those are words that are kind of an expression in price of tendencies that exist. These are very precisely looking at positioning out on the calendar and understanding not just options flows, but calendar flows that are related to reinvestment and recollateralization, looking at calendar flows and reaction functions of the Fed and the Treasury, right? These are things that you can model with high probability to within a very tight range. And when you begin to understand how that affects supply and demand and you put them together, they really map out a very high probability set of bets. Uh, it doesn't mean you're going to win every time, but it really is effective, as people have seen. So my current, again, this has been since November 1st. The call was for a sizable rally, which I believe is 10% qualifies for in a month. That would get us approaching or hitting all-time highs by January 17th. January 17th is a very precise date. This was my equity call, and we've had other calls as well that have actually been broadly bullish bond market into this period as well. And I could talk about why those reasons are in a second as well as bullish gold. And we've been very accurate with calling gold. We're not just calling the direction on gold. We've been calling the ball. And this is how we do things a bit differently on our side. The way I position in markets is not with stock or underlying. That's how everybody else thinks, right? They want to be long or short and operate in two dimensions. Often our edge is not up or down as much as, what part of the distribution is unlikely due to supply and demand dynamics. An example would be if I know 50% of the flows are very positive, but I don't know the other 50%, that means the probability of a decline is very low. Because yes, can the other 50% I don't know be negative and we go sideways? Absolutely. Could we go a lot higher? Those are positive? Sure. But what knowing those positive flows are, they limit downside more than anything when you only have a percentage of the flows. And so what we've been able to, in that situation, the trade generally is not to go, speculate on other parts of the distribution, bet on what you have a high degree of edge on, which is that the market's not going down. And you should be short the left tail, or at least downside, I would say, not the tail. And that's a different, there's an edge to that, to being able to match your informational edge with the actual part of the distribution that you're betting on. And so that's what we do. We don't just bet up or down. And sometimes that's very confusing to people, but we have been very good during this window about betting on what is that edge and betting on that as well. We've done that in the equity market. We've done that in the bond market. We've done that in industrial commodities. We've done that in precious metals. And so I want to highlight, we're not just just bet on up or down correctly, but we have bet on the correct part of the distribution, which has played out with high probability. So our view has actually been, ironically, as much as Andy and I agree on broad process, have been almost diametrically opposed to what Andy's been betting on, since we've been very aligned up until, very recently. And this is why part of what provoked this call was when we disagree, this is the time that's interesting, that everybody wants to hear about why. Why have we been so bullish stocks? I'll lay out the reasons. Broadly, recollateralization coming at the end of the year. People have heard me talk about this. We'll dive into this. I know Andy has some questions. Market's up 20% at this point. 20% rally. Again, I can't tell you the exact number that gets reinvested on January 1st, but there is a lag to a lot of the investment that happens, not to mention 10% of it just came really late in the year here. All of the 10% of a $100 trillion equity market is $20 trillion of new capital, new collateral that exists out there. That money gets reinvested. quite reliably throughout the year. Question is how much of that goes to work on January 1? And to be clear, I'm saying 100 trillion equity market. There's private equity, there's venture capital, there's all kinds of derivatives assets that are all correlated to these equities. The total asset market's 450, $500 trillion. So there is a dramatic amount of new capital that's been created. And a lot of that, some percentage of that, whether it's 10% or 20%, hard to say. But even if it's just 10%, right? We're talking, and even if we're just talking about the equity market, we're taking very conservative assumptions. That's $2 trillion in a world where 50 billion is what is driving the incremental move in markets on a daily basis during this time. So a dramatic amount of flow coming on January 1st. Entities know that this is what drives. You think it's a coincidence that Santa Claus and the Santa Claus rally, which is really the last week or so of the year, in the first 2 weeks of the year are incredibly positive in both percentage of the years is positive and size of move. It is not a coincidence. It is tied to the fact that most years the market is up. And when the market is up, there's a significant amount of reinvestment that goes into the market on January 1st. That is the primary driver. And that is the most important thing to look at here. And it is being overlooked by many individuals who don't fully understand that process. Two, the thing that's very important to me and more important than something that we understand better than anybody is the options effects. These are significant and not well understood at all. I'm going to lay them out very quickly. In December, the December expiration that you have that's coming up in just over a week is the biggest expiration period in options and structured product land and has been since the beginning of options because it is the options that are tied to leaks. These have been on the market for years now. There's a massive amount of open interest. And they are actively traded because they're at the end of the year. Another one that Andy highlighted is the end of the quarter. That's a very big expiration with, again, very big open interest. A lot of structured products, newer ones are tied to that. And then in single list equity land, it's January options expiration, which is, again, since the beginning of a single stock equity options has been the biggest expirations in the end of year hedging that is done for options. That open interest is dramatic. The skew in those markets is incredible. That means a much bigger than usual amount of positive decay to that skew. Those Vana and charm flows that are driven off the skew in those because of that distribution in the market and the amount of size is dramatic. So we'll start with potential energy there in this options exercise, which comes from the size of the positioning and the high skew in those very important expirations. Now, to add to that, we live in a period where structured product issuance is very high and vol compression is very, very high. That is why everybody's scratching their head saying, how can the VIX, given this environment, be at these crazy low markets, these crazy low values? Because of the amount of structured product issuance, that is the ultimate driver. There are other parts that are magnifying that, like zero DT and other things that people talk about, but the core lean that is consistent and unlevered is the structured products issuance. With that, the odds of a bigger vol event are significantly lower. In the absence of a tail event, these charm and Vana flows will continue. On top of that, you have an incredible acceleration during this window. When I say this window really starts in the middle of November, of positive, it's actually the second week of November that officially starts, a very small volume weighted time. What do I mean by volume weighted time? There are less calendar days during this period to begin with, but the days around Thanksgiving, the days around Christmas, the days around New Year's are all there's a lot of days where very low volume happens and very little trading happens. So the actual amount of days in reality, there is activity and that there is trading going on are dramatically lower. About 30% lower than any other time during the year. That means you're accelerating time at a much faster rate than you are at other times of the year, which means, again, it's accelerating charm flows and Vana flows that are tied to that in the market as well. Lastly, when do these big holidays fall? They fall, again, by just calendar realities, Christmas and Thanksgiving, both which are the biggest sucks on this volume weighted time, in that week after options expirations. And that is the time when volume charm flows are the least, which means you're accelerating through the weakest, most dangerous times in markets. And you're in a placid time during those windows, which tends to accelerate as quickly if you get front run into the next periods as well. For all of these reasons, there is a dramatic amount of flows coming out of the options market that is reliable and probable. And on top of that, on the other end of that, you have a significant recollateralization that we all know about. So if you put these all together, you're up against a dramatic trillions of dollars, somewhere between $2 to $10 trillion in positive flows. Again, it's a wide range. I'm being conservative with the two. I would put it closer to the higher end of that range. We have a dramatic amount of flows in a 2.5-month period. So these are the structured realities of flows during this calendar time. Now, to be clear, the macro picture, and this is why we agreed, why Andy and I were so much in agreement until we got into this window in both the decline and the rally back. But the actual amount of structured flows coming off of issuance and from the bond market are also significant. They're just not $10 trillion, right? They're more like $1 trillion. And so, yes, is that important in the context of a world where maybe these flows aren't happening as much? Absolutely. Are they important in a liquid? Would they be particularly important in a liquid time like the end of the year if there weren't these other flows? Absolutely. They would be very dangerous. Will they be important and still around after these structured flows are gone? Yes, they will. And they are something to be very cognizant of. And if anything, we can talk more about this, but given some of the palpitations we're seeing in the repo market and so far last week, I think you have every reason to believe that there is not enough liquidity, and the net effect of that liquidity issuance in the bond market is going to be greater and greater and cause greater problems. But not now. And if you're trying to time that now, you're looking for trouble, right? You're asking for a hard time here. So that's our broad view. Again, the bond market, that's the equity market view. The bond market view has been quite simple. We reach illiquidity at the end of the year. Everybody needs more collateral on their sheet. As we saw in November, the thing that caused the SOR kind of illiquidity was an end of the year drawing capital. That was a big part of that end of the year, end of November, on drawing capital. That is 10 times worse in December. And if we saw that in November, you're going to see more of that in December. But what does that mean? Does that mean the market falls apart during that time? No, it means there is a draw. People want more bonds. People are willing to take bonds at the end of the year. There's more demand for that. And in a period where the market was very, very on one side of the boat in terms of positioning that we look at in the bond market, knowing that going into the end of the year that there's going to be that supply, that demand for bonds, that is a big driver of why we've had such a quick reversal and why we have been bullish bonds into the end of the year. Again, I am on Andy's boat. Longer term, the structural flows matter, and we believe higher yields for longer. And we can get into all those as we move forward. But I'll shut up and let somebody else talk for there.
That was great, man. I took a lot of notes. I appreciate you explaining all that. Andy, I want to go to you. I was going to go to something different, and then it kind of changed my mind as we went along. Two things that you put out on Twitter that you said would be interesting. One would be a TLT rip. You just heard Cem's talk about, what could potentially happen in the bond market. I think that's, we're seeing these rally. I'm not looking at 10-year right now, but it was rallying earlier. And the other thing that you said that you have questions as well is about that collateral reinvestment. And so I just kind of want to lean to you, and I want you to maybe either talk with him about some of those questions that you had as well.
Yeah. So let me also start by saying that every position I have on is expressed in options. I agree with everything Cem said about, understanding your exposures and understanding where the tails are and where they are not. And so, if by February I'm wrong, I'm going to have a small drawdown because all my options will be worthless. And I think that's extremely important when you're managing risk, that you have a risk framework that makes sure you don't take too big a drawdown and yet are positioned well in the event that your views turn out right. And I think both Gem and I, from everything I've heard, are applying that type of framework. I guess the thing that I said is like, you heard what Jem just said, and this is why I don't try to beat him at Vanna and Charm flows around OpEx. Because I follow the ideas and I've done my own work on those ideas. And I personally just don't have any edge. And so, God bless. Let's leave that to the people that have that edge and position, not ignorant of it, include that idea into it, which includes, I think, Jem made an important point regarding single stock options in late January. That's a interesting flow to come back to. But my question lies on this idea of the wealth of a 20% rally generating a certain amount of in aggregate wealth. And the way I think about that is that all the derivatives contracts on the planet are zero sum. And this is why the pain trade is always, always, always down. Ultimately, all assets are owned with unhedged by long owners. And those individuals don't have any more money to invest. They are wealthier, and perhaps they may choose to play momentum and lever up their wealth, borrow and invest more. But only that mechanism will allow them to, it's not the collateral would have to be borrowed against for the outright long to lever up. And so maybe that's the whole idea, and I'd be interested if it is. The other question, so is that the whole idea? And then the other question is, if not, and it's the levered portfolios that reallocate some of their profit, what about the other side, who must have lost that money that the original side that has a profit lost? And how do you know that reinvestment is not simultaneously offset by a disinvestment by the losing side of the levered trade? So those are my questions.
Yeah. So first of all, this isn't just the options market, right? I want to be clear. This is, if we were talking just the options market, or, it would be some type of zero sum game. This is the increase in asset prices broadly, right? So this is not just a transfer of wealth. This is a creation of wealth. This
Yeah,
is
that's what I meant. That's what I meant. The naked long is got wealthier, and the total of all derivatives transactions didn't get a penny wealthier.
yeah, but you are right in saying it is the leverage. It is the leverage in the market that causes the reinvestment, right? If there was no leverage, if everybody was long assets and the assets went up X%, the next time those assets increase, that would be your new asset value. But the overwhelming majority of money is managed in a way that has, I guess I shouldn't say overwhelming, but more than a majority of assets are managed, and there's a ton of leverage in the system. I mean, start with banks, right? To the very beginning, where the borrowing of the whole system is built on borrowing, right? Everything is we're 10x on for the moment the money gets spent from government to banks. There's dramatic leverage in the system. So I think people often underappreciate the amount of how debt and leverage is money. The overwhelming majority of money in this world is debt in some form or another. It's all built on collateralization. But
Right. So that's really my question, which is your flow. So if you acknowledge that the net derivatives position is zero sum game from a wealth creation, and all the wealth came from, and I agree, most of the assets that the world owns are levered from homes to stocks to bonds. And but the flow that you're talking about is that it's a willingness and ability to lever even more because you have it's a classic momentum where you expect investors to lever because they are wealthier. I just want to be clear about that point.
yeah, I want to be clear that it's not a decision. I think the way you're painting it is that people are making some decision whether to lever or not. If we have $1 million piece of real estate and there's a $200,000 piece of equity and you have an 80% loan, and that piece of real estate doubles to $2 million, your equity is now $1.2 million. You made 600%, right, on your capital on your way to
Right,
2 million.
right.
Just let me finish. Let me finish, Andy. Let me finish, and then it'll just be a healthier conversation. So, but now, right? Just this is more less for you, Andy, and more for everybody else. If now that asset doubles from 2 to 4, your return on your capital is only 267% as opposed to 600%. So, in order to properly get to scale your risk. And this is all about risk, right? Scaling your returns relative to your capital to keep risk constant, right? Leverage levels are risk relative to your current asset value. In order to keep your risk constant, you have to reinvest that money. You have to reinvest that appreciation. And people like me, people like everybody else out there, right, who are managing money have to scale to their assets. They have to scale to their assets. If you're looking to get a 20% return in markets or a 10% return in markets, right, you have to scale to your assets. And it is not, yes, we have the ability to choose whether we want to delever from that level, right? But the reality is you have expectations of a broad certain kind of return, and everything is based on that. You're also balancing relative to shorts. So, if you're also taking some new shorts and somewhere else and some asset went up, then you need to take your assets that have made money and rebalance and reinvest those. So this is the process that transpires. And there may be some, go ahead.
Right. You're really defining vol targeting and doing it extremely well and accurately. If you, as an investor, want to maintain a certain volatility, which is a combination of volatility and drawdown risk, et cetera, and you have gotten wealthier on leverage, you lever up. Now, the question is, why in this very narrow window? And does it ignore value at all? I don't understand, though I get the mechanism of the levering up. It's a question of the seeming irresponsibility of levering up mechanically in this window.
Yeah, listen, when a bank,
do people do that?
Yes, 100%. Across the board, if you have a certain number of assets, you invest to your assets. The truth is, even mom and pop are naturally, they're just unlevered, are levering to their asset level. If for some reason somebody dropped $2 million more in their account, they're going to invest that $2 million. The natural thing that happens with capital is investment. And more capital means more investment. And I know you're thinking through a leverage, like a value, like, oh, these things were worth X. So, or their fundamental value is Y. This has nothing to do with fundamentals. This has nothing. This is a mechanical process.
But it's literally the way bubbles blow.
Correct. Correct. This is why it happens again and again. This is why boom and bust is essentially, there is a natural set of mechanisms that are momentum positive mechanisms. This is why we leverage and leverage and leverage in a system, and then we have a deleveraging that blows everything up and we start anew. So, I mean, this is not a moral decision. This is not a rational, like, what should be done. This is how the system works. this is a process, and I'm not here to debate, you know, anything other than what actually happens in the system.
Right. And where I think we disagree, which is fine, um, is the narrowness of the mechanics of that levering up, both in time and space and value, I guess. That
I would argue the more levered participants operate on a slower time frame. Think private equity, think hedge fund long shorts. A lot of these things happen on a quarterly basis or annual basis. Um, you know, that's not saying all of them, but there is a higher propensity for some of the things with lags to go in first of the year, if anything. I think, again,
is
potato,
there any,
potato, whether it's 10% or 20% or five, but the point here is a significant amount of this reinvestment does happen not at a monthly basis, definitely not at a daily basis. And the question can debate how much it is.
right, is there any evidence that it occurs in terms of investor leverage from a, does repo blow up in this level where every investor is taking on more repo exposure? Is there any evidence that it occurs besides price?
Is there any evidence? I mean, I guess this is not something that we can uh, measure, which is what you're asking me to do. I wish I could. Uh, it is something that we have, again, other than price, that we have to understand the mechanics and understand the broad scale of and use accordingly, which we have to do with a lot of things, right? There is
Yeah,
a
I'm
lot of
just trying to
opacity in this
triangulate. For us, for both of us, I think we could learn something if we saw triangulation points around this levering up that you're describing, besides price.
I
Price,
want to be clear. I don't like the way they keep calling it lever up. We're not levering. We're keeping a continuous leverage,
that's fair enough.
and I think that it is not an action to choose to take more risk. It is an action to decide. I just want to finish. It is an action that is choosing to keep risk constant.
Right. I think adding debt is levering up, but I agree that it's
Well,
maintaining.
you're
I,
adding.
I agree it's maintaining risk.
Yeah, it's maintaining risk. It's keeping risk constant, and I think that's the part that people get wrong. I think people think, oh, there's all this leveraging up happening. It's not leveraging up. It is keeping leverage constant relative to your assets. And that is the process that ultimately is the natural state of things and what naturally happens within the system.
I think your explanation is perfect, totally logical, and I would love to see it triangulated with something other than price. But, we can only hope for things. That, for instance, that's what I try to do, and I don't see the triangulation. So it's certainly possible I might be missing it.
Yeah, I'm happy to have more conversations and see if we can, come up with a few ideas and ways we can see it more clearly. But it is a very, very kind of opaque thing to measure directly.
So, guys, I mean, if there's anything I've learned is when you get two bright guys like you talking about something, just let it go. And I'm sitting here, and like I said from the beginning, this is definitely not my world of understanding to the level that you guys are, of course. And I think for the audience is, and I'm sitting back as I'm listening to this, and I think Andy made a point about the bubble, and in my mind, that's what I was thinking of. And it talks, I've heard you talk about this as well, Jem, where you talk about kind of like this blow off top. And what I'm gathering from this is because of what you're seeing in terms of flows coming in with a limited amount of time and the timing of the year, the amount of flows coming in, this is what is really one of the driving force behind this bullishness at this time of year right now.
Yeah, I mean, again, I think it is the most important in an up year like this. Doesn't mean it's the biggest every year, right? I want to be clear.
Yeah.
And I would say this year, again, to highlight the kind of options effects, I think that's something that's there every year. And so it's not just this, it is also the big expirations, the high skew, the acceleration of, the low volume weighted time and the amount of decay of the distribution and the open interest in that in this time of the year that is also very supportive. And you pair that with a consistent vol supply that we're seeing for, and it's a very structurally supportive time of the year broadly. And with the flows coming in behind on this recollateralization, it's really too hard to fight.
Got it. Andy, I want to go back to you because there's a few things I want to talk about on the macro side. I want to come back to that a little bit. I mean, you are coming more from the macro side in this conversation. You earlier mentioned JP Morgan Collar. I'd like for you to talk a little bit deeper into the macro situation that you're seeing right now and how you believe that has the ability to counter what Jem is saying.
Yeah. So, I mean, I think you have to step back a little bit. I was pretty damn bullish like a month ago, like
Yeah.
buy all assets and, cover all shorts, buy all assets. And so now I'm not as bullish. And that's partly because, geez, we've had a 13%, 14% rally in TLT. We've had NASDAQ seems to be stopping rally, but taking over by Russell, but stock markets broadly are up, 10% in a month. And so I guess that's where the macro comes into play, which is um, there is the big driver for the change in the interest rate curve in the last 7 days has been a speech by Governor Waller, in which he opened the door to cuts in the Fed funds rate using the modified Taylor rule idea of if we want to maintain restrictive conditions and our expectations for inflation are falling, we mechanically have to cut rates. And that created a significant move in every short rate market, generating now what is, I haven't looked at it today, but I think 140 basis points, 125 basis points, 5 cuts priced into 2024. And so I think that's a significant easing of financial conditions just already that is impacting the real economy because that's what's priced. And now the question is, will the Fed deliver on those 125 basis points of cuts? Now, the second thing I noticed in the macro is that and this followed my script through till October 31st when Janet reversed the script, that what you need to really slow the economy is higher long-term interest rates. And Governor Logan started the conversation in mid-October, and that lasted all the way through till Powell at the presser, which ironically came right as the rally began because of the QRA supply issue, which, by the way, is not big enough to move the market this much, but was a good catalyst. And the point they were making was that high interest rates were doing the work of the Fed. And that's a fact. That's what it takes. That's what the goal of quantitative tightening is. It's to make assets fall, have the wealth effect, result in less demand. And that's now been not only erased, completely erased in the last month. When you look at long-term interest rates now back to where they were in August. And so we've had a massive, massive easing of financial condition. And I'm just beginning to fade that in my positioning, expecting financial conditions to tighten and the portfolio of bonds, stocks, gold, et cetera, starting to roll over as financial conditions tighten. But the Fed can validate on next Wednesday through their SEP plot, can validate these cuts. It'll be very interesting to see. Will they, we have the December 2024 dot, which currently has an interest rate of 5.1, which is a little elevated because they didn't hike in November and December, as was originally expected in the September SEP. But how much will they bring it down given markets have already priced that dot to 3.9%? My guess is the combination, despite their comments about the path of inflation resulting in a mechanical need to cut nominal interest rates, the offsetting massive easing in financial conditions that they welcomed in October have completely disappeared. And so my expectation is we will get much less cuts than expected in the SEP, and we will get rhetoric around that long-term interest rates have made the Fed's life more difficult, not easier. And both of those things are bad for assets.
So I want to say, first of all, Andy and I both saw that it's coming. The reason we lined up so well is not just I had this added scale of the move that doesn't surprise me. I think it surprised Andy a little bit because I had this knowledge of the options flows and the recollateralization of the end of the year and what was coming. So that pivot, I felt confident was going to be very big. But highlighting the pivot and the catalyst, we both caught, right? There was a clear, to me, reflexivity with the market down 12% from its peak, going into the end of the year with low liquidity, with a new war kind of in Gaza and all the geopolitical. There was a need to make sure markets didn't fall another 10% into the end of the year. And given the amount of liquidity draw, it was clear to me that the Fed and the Treasury were going to blink. And to Andy's point, that's what they did. They blinked. The size of these moves was not dramatic, right? But the signal was enough, right? Given the ball supply, given the amount of time that needed, how quickly that next move had to happen if it was going to happen, to set off a spark to let this thing follow the flows. And that's what happened. And we both saw that pivot, and that was key to being able to call it in time. But the way markets work is they tend to have both momentum factors and reflexive mean reverting factors. And a lot of the things I've talked to about this point are momentum factors. The end of the year, they're all bunched into the end of the year. Momentum factors are very strong because of the calendar, the way those things work in this window. But there is still a very reflexive, mean reverting reflexive factor, not only the markets writ large. If they go up, you get sellers, you go down, you get buyers. You have that mean reversion. But if there's a reflexivity to policy, both the Treasury and, more importantly, the Fed are vol dampening in general, because they are trying to, manage risk both to the downside and to the upside of markets. Much like they blinked with the market down going into the end of the year, you better believe if this market does rally and the momentum that I'm talking about does continue into January, you're going to see, and already starting to do it, right? A blink the other way and a desire to kind of sell calls, if you will, right, on the market to try and look if there's an opportunity for the Treasury, if the market keeps going higher, to especially after the end of the year when liquidity dries up, to increase issuance and take advantage of a strong market and lower yields. They're going to do it. If the Fed can take this opportunity to again, increase down the expectations for higher for longer in order to manage a softer landing as the market rallies back, they're going to do it. And so I think both of us think about those effects, those mean reverting effects. I'm not, that definitely plays an important role, both the reflexive effects of policy, but also the reflexive effects of markets writ large. There's a reason February is the second worst month of the year. It's not because February is a very bearish time. It's because December and January are so bullish. That's mean reversion. That's a lot of these mean reverting factors. It's a response to the bullishness that happens from November really till January. And so I think that's a critical thing to understand. I agree that these things will matter. I agree that there's reflexive mean reverting factors. I just think that doing that without understanding these flows and the important role of momentum in this time of the year is getting the timing wrong.
Got it. No, timing. And I want to move on. I actually want to talk a little bit about the divergence we're seeing in the Dow Russell versus the NASDAQ and even the S&P. I mean, look at this tape lately, guys. I'm just curious what your thoughts are. I mean, obviously, there's we have the push and pull markets because of some of the things you guys are talking about, macro pushing back, and we talk about gems flows pushing us up. I mean, we are still really kind of grinding higher, but this divergence between how the Dow and Russell have played major catch up at the end of the year versus tech, Nasdaq, which has slowed down and just kept S&P in this kind of really chop fest. I'm curious just overall what you guys think about what has happened in the small caps and the Dow as of late, and how and why you think that's happening in the market right now. Maybe we'll go to Andy first.
Yeah, so I think that really speaks to my dead Santa analysis, which is people could sell their Nasdaq stocks because they have losses, and those things have run a long way. And it seems sensible to sell. Basically, what I think is happening is the classic January effect, which is the dogs of the Dow, the losers from prior years, are getting bid up in December, where they normally have to wait till January because of the deferral of tax selling associated with and the realization of tax losses that occurs in this seasonal period is not in play. And so it makes sense that you're getting essentially a January effect in December.
Yeah, I have a very different view on that. For one, I think there's much more structural causation to why this is happening. I've called for this trash stash, right, for a month and a half. The reasons we're seeing this trash stash are not for the reasons, in my opinion, that Andy is highlighting. It's for two structural reasons. One, it's the pain trade. We're entering a very liquid time, as I mentioned, much less volume weighted time, much more illiquidity. It takes less to move markets during this time. And these are what is happening right now is the shorts that hedge funds have had on are being covered. Part of this, there's a broad market squeeze, which is a short squeeze, but they're also like a lot of pain if the trash goes higher. And that's why often you see a correlation between short squeezes, right? Fast moves, short squeeze of the market, and poor, low quality outperformance. This is a consistent thing that happens as a function of hedge fund and leverage long short funds having to get out of what that is not working. That's a big part of it. The other structural factor I'd like to highlight is dispersion. Vol dispersion has grown dramatically in this market. There are now 20 pods at Millennium to over $3 billion doing massive dispersion books because it's been so profitable. There are many, many more across all the other shops. I'm just highlighting one of the biggest. That dispersion world is a big reason why those 7 stocks have worked so well. There is an unbalancing that's happening in the market. Index vol is in, right? From all the structured product issuance. And from a structural perspective, the short vol is in the other places to the upside that have performed. And that squeeze is, again, as a momentum factor that exists there. Now, what's happening as we hit the speed of this rally is vol is starting to go up. This is, again, something we highlighted on the distribution. Market of vol up will likely be, I've highlighted this, the last part of this move. And we're starting to see that, especially 2 months out and further. Long dated calls have reached a bottom. There's a structural demand and floor that's being drawn underneath that vol. And when vol hits a bottom, you tend to see reversals in this dispersion trade because now you're beginning to get index buying that is squeezing out some of that structured product issuance and the supply. So we're starting to see that. We're starting to see let me just finish that. We're starting to see the beginnings of that now. And when that starts to reverse, you also see the reversal in the dispersion trade. And that's what we're seeing. Dispersion is not performing as well. And the winners tend to reverse relative to the losers. So that's not the core cause, but it is also providing a leverage tailwind to the reversal, which was a very heavy positioning coming into that.
Yeah, I wanted to say that as well. You can't pay attention to momentum fund positioning and not notice that a lot of what we're seeing in many assets, including Russell versus NASDAQ, but in particular in bonds and in particular even further in short rates, you can't ignore the fact that this Wednesday um, Waller speech that has resulted in a 50 basis point move in twos is not causing a significant short squeeze across many, many assets, including other things that these people are getting squeezed about in, which includes the Russell versus QQQ.
Absolutely. And I think the liquidity, sorry to interrupt, but the liquidity factor, the fact that low liquidity places in the market are the ones that are going up the most speaks of there's just so little. Again, that pain trade right now during this liquid time of the year tends to happen more because this tends to be a liquid. And it's something that also can tend to lead to market up vol up. So if the market is continuing to go up based on the factors that I'm talking about, and it does continue to be kind of violent, painful trades in different parts of the market, that's also correlated with higher volatility. And as you're reaching a nadir, that's another part of the thesis why we're likely to see a much more kind of uncomfortable rally. And that is what, if that does transpire, the thesis has been that would be a perfect setup for a much more bearish Q1.
I want to move on and talk about gold a little bit. I've heard you mention it so far in the conversation a little bit. Jem, maybe we'll start with you there. You said you've been bullish gold as well. I also just want to get your thoughts on a lot of people putting out there that's saying gold breaking out, it's a warning sign. um, what are your thoughts on, obviously your position long gold, but what are your thoughts about gold being a warning sign by rallying and breaking out, and just your overall thoughts on the next moves in gold?
Yeah. So again, not surprisingly, I'm not going to be the guy who tells you based on relative to bonds or some fundamental, short-term fundamental reason that the move in gold is happening. I'm going to be the guy who tells you based on structural realities to supply and demand why this is happening. Gold historically is, as everybody here knows, is not really a commodity in the way it trades. It is a currency, and currency vol historically during periods of populism, periods of inflation, um, have dramatic volatility and tend to, the stronger currencies or more fundamentally strong currencies tend to have strong upside volatility. Uh, think of the dollar, think of gold, right? These are things that tend to do very well, but tend to be very volatile throughout the process of these broad secular periods. We highlighted early this year, late last year, early this year, that gold's down move or out underperformance relative to all the other commodities that move first, both in terms of direction and in terms of volatility, was significant, and given positioning was a dramatic opportunity for the 2023 year. That's something we highlighted again and again. Again, the distribution. What did you want to own? Not just gold, but you wanted to own gold calls and really longer dated gold calls. And that has been both in size of move, direction, and implied volatility, the exact right call. Why does this happen? Several reasons. One, this is a time of deglobalization and geopolitical conflict. This is something that's much bigger than the short-term flows that we've highlighted for a couple of years, and that has been a big macro trend that's driven a lot of positive price action in our direction. When you have geopolitical conflict, there is a bifurcation in the world, right? Populism drives people first, and people of a country first, whereas capitalism really drives cross-national flows and peace and a lot of other things. So what we're seeing right now is a broad period where the Fed is losing somewhat of its power and somewhat of its control, which drives more volatility in assets. The Fed put is significantly weaker and put it in other terms. And when the Fed gets weaker structurally, people eventually, and it's not a straight line, start looking for other places to be safer. They feel less safe and there's more risk. Um, One of the greatest beneficiaries of that historically is gold. There aren't many other places. There are very few alternatives to the dollar in other places where that can be considered safe. That flight to quality of gold is the primary driver. Now, geopolitical conflicts will create volatility to this, and the push and pull of cyclical effects versus secular and inflation coming and going will create some significant volatility to gold, which is a liquid asset as well. So you really want to play that with calls. But that was why we highlighted it up front. It was dramatically underperforming where it should have in 2022. We highlighted that, and again, particularly relative to industrial commodities. This was the one thing left that was really a dramatic hedge to a broader structural cycle that we're seeing. That's the bigger picture story. Why is it starting to really pick up speed here? Because people are having to get back on sides. People have been shorted, have been under, putting mean reversion in it and not understanding the bigger picture momentum, regime change realities of the product. And now that we're starting to really break out, there is a covering of shorts. And again, that ties into some of the other things we've been talking about here going into the end of the year as people prepare for the next phase of this macro cycle next year.
I was going to say that's fitting into your theme and to all the things we've discussed today. Andy, gold.
Yeah, so I think it's very interesting to look at gold. My basic framework is it tracks real interest rates because it's a currency. And real interest rates have had an interesting journey from since July 31st. Gold following real rates down. And then following as real rates rose, it fell. And then lately, as real rates fell, it rose. And so that's acting very typically. But I would note that the day that gold made its bottom in this last 6 months was the day before the Palestinian bombings, the bombings of Israel, and the beginning of the Gaza conflict. And I think what has happened is there's been two things that have gone into gold. And by the way, as part of a beta portfolio, I own gold and I will always own gold. It is an essential, and only crypto compares, an essential thing to own to maintain purchasing power. But it rallied, after that blow off top, it's rallied 12%, 13% from the lows, and it has overshot its relationship to real interest rates and is at a premium in my view, relative to other assets that it tracks, simply because of flows of money. There's been a consistent flow out of the US dollar into another form of the US dollar being gold, around with all of, back to Russia and Ukraine, but ever since then from our enemies. And I believe that was exacerbated, and you can see it in the reaction that the Swiss franc has made, and Bitcoin has made, that there is a premium that I would say is the flows around people that don't want their US dollar assets to be confiscated, who are, in some ways enemies of the state. And so I don't know when that reverses, but it has overshot its value. And, I got shorted and underwater on that as well. But I think that's the right position to have, because I don't think those flows of abandoning the dollar and heading to gold to protect one's wealth happen immediately upon a war and then revert.
If you look over longer data sets, I mean 100, 200, 500 years, gold is not tied to real interest rates. It is tied to real interest rates in the last 40 years. And I really think, from my perspective, that is ultimately what's going to drive that misunderstanding and that lack of um, kind of understanding of that we're entering a very different regime than the last 40 years. And gold's role and importance in this regime is much more than its relationship to interest rates. I think that value to gold, I think, is really going to surprise a lot of people who have really been playing this mean reverting game, right, for the last 20, 30, 40 years. And again, that depends on my thesis that we are structurally in a time of populism and higher structural interest, inflation and deglobalization, which again we've had for three years or so, and we've been very accurate on. There's a lot of questions coming in, right now about deflation and is inflation dead. Again, I'm much more in the camp higher for longer. Core inflation will be higher due to all the reasons I could go on and on about. But I think as long as that thesis holds, which I believe very confidently, and I continue to look for counterexamples more structurally, I think gold has dramatic upside and very volatile dramatic upside. It won't be linear. Again, it will be volatile, but I do think you risk, the risk of playing mean reversion in this type of an environment is very.
Yeah, I mean, listen, I completely agree with you, and that's why I own it for beta and always will. The point I'm trying to make is that my framework includes real interest rates as one of the drivers, and that one has been distorted by other drivers that I think are specifically the ones you're mentioning. In particular, it's the two other drivers are monetary inflation. People say it doesn't track inflation. It does track inflation when there is monetary driven inflation. And that's could be ahead of us, or it may not be ahead of us. And then there is central bank credibility. When central banks, and you can decide whether you think central banks are credible or not, and no one's level is going to be the same. But the change in that level of credibility is a driver of gold. And so when broadly central banks become less credible, gold does well. And then I guess the last thing is there's also this, and maybe this is specific to why the skew is already smirked to the upside. There is the tail risk of fiat collapse. Now that's a way out of the money call option, but it certainly exists. And I guess what I'd say is all four of those things are in play. And the two first ones, which are the potential for monetary inflation, and including this idea of not getting your wealth confiscated, are important drivers of both crypto and gold right now, and may or may not revert. But I don't think the other two, like credibility of the Fed, is at issue right now until they make a policy mistake. And I think both of us agree they may do that.
Yeah, I want to highlight. I agree with all the reasons Andy highlighted could be positive for gold. I would highlight that all of them are part and parcel to broad populism, geopolitical conflict, and if I'm correct in my broader thesis, which again we have been and we continue to look for counter factuals for, all of those things, the probability of every single one of the items that Andy highlighted increased dramatically. And I think that's the point. This bet on gold is a broad bet that those probabilities are way more elevated relative to what people are realizing. And I think the war in Gaza, for example, is not just as people are talking about it, kind of an idiosyncratic event. And again, people look at it like, oh, gold popped because we had this war, but it's just another war. It'll come and go. It is another front on, a bifurcation between East and West. Iran is part of Russia and China, and the actions by Hamas are very much angled at separating Saudi and Turkey away from the West. I think those greater realizations speak to that as a momentum driver and not something that's just a short-term mean reverting event, as an example.
How do you guys feel about Bitcoin being in that same conversation with gold?
Did you say Bitcoin?
Yeah.
Totally not my lane. I don't know shit about crypto, but I would say the following. It appears to me that crypto in broadly and Bitcoin specifically have now become driven by, are more correlated to what drives gold than ever before and less correlated to what drives meme stocks than ever before. And I think that's a victory for those who believe in Bitcoin. Does that mean it's going up or down? I have no idea.
Yeah, I think over the next 10 decade, 15 years during this regime change period that we're talking about, primarily because the adopters and believers in Bitcoin are millennials on down who are now growing to political power, because they are the ones that are ultimately driving policy, driving money flows. I do believe that Bitcoin will be a hedge to inflation because people see it as such. Much like gold, its value is because people believe in it as a store of wealth. I think that simple fact will continue to support in the next decade crypto values, much like I believe in gold. That said, from a much longer time frame, if we're talking 20 years, 30 years, 40 years, which again sounds crazy, but time moves fast. I think crypto itself needs a sponsor. Without United States or China or whoever adopting Bitcoin and allowing it to flourish, which I think is in the is not in the interest of those entities, right? We moved off the gold standard for a reason here in the U.S. because it allows us to take advantage of our power and the power of fiat, and our exorbitant privilege of the U.S. dollar is much stronger as a function of being off the gold standard. We do not want to be hemmed in, as unfair as it may seem, by a constrained general ledger. And because of that, both China and the US and powers that be will not succumb to the demands and desires, right, of a more constrained financial system and currency. Because of that, long term, I think it is overly idealistic and unrealistic to think of crypto as an alternative in the long term for the dollar, and for power writ large. So again, broadly bullish. I agree. It makes sense that it moves much like gold. It will be volatile, and if I'm right about my inflation thesis, that people who will be buying it and will see it as a store of wealth will support it over this period. But longer term, I think there's a dramatic risk of some entity, probably the U.S. at some point, much more driving much more regulation, much more maybe even banning Bitcoin at some point. Much like we took ourselves off the dollar, I think there's going to be lack of a sponsor, a real sponsor, and Bitcoin will be eventually relegated to a third party currency, which is not, allowed or at least regulated extensively, um, you know, in the longer term.
Well, guys, you guys have been so gracious with your time. I'm going to leave you both with this last question. We've heard from you what you guys are thinking coming into the end of the year, even into January. We've heard your positioning, thoughts on gold, Bitcoin, Fed, interest rates. The next QRA announcement comes in January. Andy, we're going to go back to you. You have been bringing this to our attention on Twitter. Two of the last moves you've caught because of this QRA announcement. What will we be looking for?
Well, I think there's two possibilities. The existing supply actually, which begins to come to market next week, is not absorbed as easily as markets are currently priced, and the Treasury is still nervous or has political reasons to continue to juice the economy. That'll depend, obviously, on inflation, et cetera. Or they decide to do what they really need to do and will eventually have to do, which is issue, significantly more long-term duration and less bills. The bills is actually creating a little bit of a stress. And meaning the bills are now trading and lifting SOFR up a little bit as well because they aren't being absorbed as well as maybe markets would like, which is a concern. So I guess the simple answer is I don't know, but I think I will know the moment they give us the information, and I'll watch it and see what it is and react accordingly.
Jeff?
Yeah. So I think Andy brought up this is, when we start looking medium term, this is where we start to align again, right? If we once you get past this January 17th window, right? Maybe a couple days before even, January 14th, I don't want to, let's give that some breath. And it might switch to February, much like the COVID crash did. Um, Look, this is actually, I just said COVID. Let me use that as an analogy. We knew about COVID. Can you think of a bigger fundamental driver, a bigger macro thesis that people were sitting and talking about in late December and early January, whereas the market continued to rally for not just late December, but January into all the way to mid February, and vol continued to get compressed into that period. You're talking a 2-month rally in the face of COVID. Everybody forgets about that. People think the news of COVID came out, the market crashed 30%. No, the news of COVID came out. We rallied for 2 months, vol got hammered for 2 months, and then we crashed. And I think that's very kind of how these things work, right? If there's a period of positive flows, if there's shorts to be squeezed, the vol is well supplied, you have to kind of bleed out those flows before the macro takes over. And a lot of times the pain trade happens right before the decline happens. And so what I've been highlighting here is this is a period for a pain trade. It is a period of positive flows. It is a period where, yes, there are macro negative flows that are more important longer term and that are consistent, and will, in periods without those flows, overwhelm and take the market lower. So I do align with Andy in that view. And again, it's just that I don't believe it's really possible, given the amount of flows. Doesn't mean the market can't decline, but in any meaningful way for this market to decline during that period, in the absence of a meaningful decline, that you have all the decay of vol and skew, and all that recollateralization that will push us higher. So I do believe that come January or February, we'll get a decline based on issuance, based on a lot of things. In particular, I think that SOFR spike at the end of November is a canary in the coal mine. Quote me on that. It's not going to mean anything for the short term. It's going to kind of come and go. We're going to forget about it. But guess what? When we start to see a greater and greater drawdown in reverse repo, which we're seeing, and less liquidity now all of a sudden, and demand exists again, we're going to get through the end of the year where there's plenty of demand for bonds and T-bills. When that is gone on the other side of next year, and markets are higher and vol is becoming a little bit more unpinned, and there's more potential energy given that we've gotten a rally, that's when the groundwork is laid for a decline. And the big question there, and it could be a big decline. I don't want to scare people. It could be more, what kind of decline that will be is really dependent at that point on the Fed and the Treasury and what they do and how quickly they react and with what scale. If they react, and again, it's not just going to be blinking, if they reacted to that 15% decline, and not to mention, again, not just Treasury and the Fed, but what's going to happen into an election year? If we get significant fiscal policy responses into what is maybe a slowing economy, right? Also, a poor market for the first quarter. If we get a positive liquidity response in that period, I think we could get another big rally, and one that's bigger that takes us to new highs. And that ultimately is the end of the move. If we don't get that response and they don't act quick enough, could that be something uglier that really in an election year starts a much bigger, broader decline? Yes. And so next move after that will depend on the reflexivity of the response and how the Fed and Treasury responds. And that is still TBD. My bet is in an election year that it'll be all hands on deck eventually. And And the size of that move will probably be a function of the speed and scale of the response from all three liquidity providing entities.
We didn't even get into the thoughts from you guys for on an election year, but this was so great. I think we're gonna have to do round two of this at some point. We'll have to wait and see how the end of the year plays out into January. I can't thank both of you enough for joining me today. I continue to learn from you, and I hold immense respect for you both. I know how much family means to you guys. I wish you and your family a joyous holiday season, a very Merry Christmas, and just a fabulous New Year. Traders, everyone that tuned in today, this session will be available on anthonycrudele.com, where you can listen on iTunes, Spotify, YouTube, or wherever you get your podcasts. To my fellow FinTwit community, how great was this? I wish you all as well a wonderful holiday season and a very Merry Christmas. Cheers, everybody.
Happy holidays. Thanks, guys.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.